So, relative to other asset classes, equities and bonds, real estate is a long-only asset class. So, all of my colleagues here will be building portfolios, they're buying assets and they're accumulating assets. That is what they do. They will continue to do that through the cycle regardless of where we are in the cycle. In fact, as cycles tend to show historically, you tend to get more money at the peak of the cycle just before the downturn. So they're incentivized to buy assets with that money. So that won't stop. But investors also make that decision when they give money. They're locking their money up for a 5 to 7 year hold period, because when you buy a building, you can't sell it the next day, and you've got to realise your 8% round trip costs. In the UK, 6% on the way in, 2% on the way out. That takes time. So it's very different to other asset classes in that respect, which is why I would say the tools haven't existed either to manage property market risk historically. However, they now do, it will take time for investors to get set up to use this tool. They will only do it when their investors start to say to the funds that you should be managing our money, not just buying assets. We want you to here's £100 million. We want you to manage that money in absolute terms. And if there's a market fall, we don't want to lose 20-30% when the market falls. We want you to outperform the market and perhaps have positive returns. The tools now exist to do that, so hopefully in time the market will adapt and adjust and use these tools. I hope that answers from a high level the question.
And it's a different way really of managing that risk in a way.
Yes, I mean traditionally property risk management has all been about good, solid asset management at the asset specific level. So I'd say from the bottom up.
I suppose you need both, don't you?
Say again?
You need both, don't you?
So if you have the ability to manage risk at both levels, i.e. the asset-specific level and from the top-down market or portfolio level, my question is, why wouldn't you use those tools? The fact is, I've just said, it's a new tool, so it'll take a while for the market to adopt it and to use it.
Charles, is this essentially derivatives on IPD indices or MSCI indices?
Yes.
Or are you thinking of other tools that would actually correlate very well with the underlying performance of real estate?
So let me be specific here. I'm talking, and this is only available to UK investors at the moment.
Yeah.
I'm talking about IPD listed futures contracts on the Eurex exchange. So the characteristics of these mean that they're 1 year contracts. So you're buying or selling exposure to the property market in 1 year chunks. So at different points in the cycle, you can go risk on and risk off in annual chunks. These products have guaranteed cash liquidity at settlement, so it is the most liquid property product on the market. It's also very cheap to trade, and you get daily transparent pricing, so at any point during the year you know exactly where you stand with that contract, and if you want to trade out you can. So it's the product exists now, obviously.
Did you see any significant change when the referendum, for example, was announced on the 19th of February?
Very good question. I was going to come to that. In terms of, let me give you an example. Last year we had the election in the UK. The day after the election we had a client, a hedge fund who can move nimbly and quickly, doesn't need to get lots of approvals. He came to us, he said, look, I want to buy the rest of this calendar year. This was back in May last year. I want to buy the rest of this calendar year. I want to buy 2016, and then I want to sell calendar years 2017, 2018 and 2019. And effectively he was the first person back into the UK property market. He did that trade a week later, and people in the direct market are still signing completion contracts today, sort of over 6, 7, 8 months later. So yes, in terms of reacting to a strategy, you can do it in real time, and that doesn't necessarily mean to say that is your strategy. It can be complementary to your direct assets. So it can be like an overlay strategy, or if you're in sell down mode, you can sell down in the futures market and then sell the assets over time?
Richard, what we've seen in the UK in particular is investors have become increasingly sophisticated. I would say that probably 20 years ago, about 90% of our client base was relative return seeking, i.e. wanting to beat a benchmark. Today, I would actually probably have 6 or 7 different investor types. A small fraction of which, not a majority anymore, looking for relative return. An increasing proportion looking for absolute returns. Saying for example, I want a 6 nominal, or I want a 5 real, or 4.5. An increasing proportion seeking for inflation hedging returns, or index-linked performance, such as a substitute for index-linked performance. So I think those tools would be incredibly useful for those looking for a given level of performance, and then at some point just hedging against the downside risk. I think it's the level of understanding of the general market, having those tools included in the IMAs, etc., is probably a hurdle today. And I don't know to what extent the existence of futures back in 2008-9, were helpful to some, but not. I don't think to that many.
Yeah, so
but I think in this time around, maybe
2009. They launched in 2009,
exactly,
so they're a new product.
Yeah.
I wish I could use so sophisticated tools like Charles you are developing here, because it would actually help to have the direct investments, the nitty-gritty asset management, and then to overlay this with some risk buffer, if you like, with derivatives. But if you're a German Investment Act regulated fund, no way we can actually do that. So back to you, Christine, could actually develop this further. So it's nice, but we need to actually be at the coalface of the direct real estate, and anything more removed from the asset than a leasehold, if it's long enough, unexpired term, we could redo. So brave new world, not for us.
This is risk management for the industry, the property industry.
Yeah.
It's slow to change, it's slow to evolve, and that in itself is a form of risk management, and that's a good thing. We're well aware of the hurdles that the product faces, IMAs, getting investors to understand the product. Education is a big thing, but we've got the time and the perseverance, and
maybe
we're happy to do
one
that.
aspect which I thought at the time, back in 2006-7, could have been helpful is actually, instead of using an index derivative, maybe using the listed market. But even our securities team find it very difficult to deploy strategies with long and short positions in the buying and selling REITs. So it's quite a tricky education to get institutional investors.
Can it be very boring? Can it be very boring? Having just seen the Big Short for the 5th time, the film. I think it's great. I remember when I was at university in London in 1990, they were talking about property futures.
That's right.
Derivatives.
Fox
that was
Exchange.
26 years ago. So good luck, Charles. Really, honestly, wish you good luck that this cycle you may actually get this through, because that was a big idea, and then it actually was quiet for 20 years. I think somebody at the coalface of real estate has to develop a building, finance it, find the site, get planning consent, get a tenant in, and manage the tenant and the operational risk to such an extent that there is income being produced. And primary income, fundamental real estate income, rather than arbitraging on derivatives and futures and these things. So I think it's a great idea if you can overlay this, but at some point we need to crack the dangers we see in the market out there for the fundamental risks we have in a real estate portfolio, rather than a derivative of that. That's my point of view.
Can I just add one point, because we have discussed this with some of our institutional-based clients, and I just heard you say, a lot of these contracts are one-year contracts.
Yeah.
And when I think of the strategies that we're trying to deploy, a lot of our investors are looking for long exposure. And what they're really concerned about is the end value, protecting the capital value at the back end, which usually is at the back end of a long lease. And that's, I don't think that's as easy as given the instruments that we have today, which are more, I would understand,
which is where sustainability comes back in, by the way.
And protecting that capital value, they can live with a bump in the valuation, as long as the income is there and it's secure and it's stable, and it's inflation hedged or has some characteristics of growth embedded in it. But it's the end value, protecting that end value, that we really struggle to get into, long-term protection.
And so, by the end value, you mean
That
when
would
you
be
come to sell it, or when
probably, yeah, because the intention
And
is
that
usually a
could
long
happen.
hold. Yeah.
Okay, so let's say that happens in the downturn part of the cycle.
Yeah.
There's nothing you can do unless you protect the capital values, let's say with a 1 year hedge. So the property cycle is easier to read than other cycles like equities or bonds. So it's just a question of knowing where you are in the cycle and then taking counter-cyclical measures to manage your market risk, as well as do all the things you do on a day-to-day basis, managing the asset-specific risk through good asset management. Again, if the tool's there and you want to protect those
I think if
capital
the
values,
tool's there,
why not?
Some investors may want to actually
It's
include it.
not for everyone, but yeah.
Isn't it all coming down to the user in the end? So you were talking about the property level. So if you can manage to increase the satisfaction of the user and make him agree on longer terms in the lease agreement, I think this is one thing we are talking about here. It's just other words. So this is something, the most important aspect when you speak about risk management, I think. So
But let me be specific here. We're not talking about the income part of the investment. That should be taken care of by the asset managers, and that should be protected and enhanced by the good asset management. We're talking about protecting just the capital value part, and that's all of the futures contract will do is to protect capital values at different points in the cycle. Or indeed, when you're at the beginning of the cycle, you might want to increase exposure, so deploy capital into the market quickly and then find the assets, buy them, and then sell down your exposure in the synthetic.